Today on the Final Bar, we'll talk about the pullback in stocks, what that means relative to the weekly trend, what that means relative to the big picture. Groups like biotech rolling over, breaking to new swing lows. Also looking globally at the chart of China and other global ETFs. Where are we headed going into the weekend? How should we think about it going into next week? We're also going to answer your questions from the Final Bar Mailbag, specifically related to fundamental data, including earnings on the StockCharts platform. So ladies and gentlemen, this is the Final Bar. Hey everyone, welcome to today's show, The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday here on The Final Bar to take a look at today's price action from a technical perspective, connect it to the proper long-term perspective, and understand how today's movements fit into the week, fit into the month, and longer-term timeframes in line with your investment horizon. We really appreciate your feedback and your questions. You've done such a great job of letting us know what we could do better and giving us a lot of great questions that we can address on the air. And for that, we're really appreciative. You can email us at thefinalbar@stockcharts.com. We read everything you send in. I'll get back to some of you directly, and a lot of them we'll be able to address on the show. Also, during the show, just put a comment in the Q&A section. We'll capture that and address it later when we can. So quite a pullback today, right? We've talked this week about that 3210 level, how important that is. I have to be honest, I did not expect us to hit it today. We did, though. And so the question now is leading into the end of the week. What does that mean, right? How does that fit into the long-term trend? So we are going to start with the Final Bar. We're going to look to the left today, see how in key stocks and in the broad market, today's movement relates to the long-term support and resistance levels. What levels, what lines in the sand we want to pay attention to going into next week and beyond. I did want to point out, coming up on the show, we have some really fantastic events, fantastic guests here as well. Next week, we're actually going on the road. We're going to be in Atlanta. So we're heading out there Monday. We're actually pre-recording most of the show for Monday, but it's a really cool interview with JC Pretz that we have lined up for you. You're going to want to watch that one. And then we'll be at the Money Show in Orlando Thursday, Friday, Saturday of next week. And we're going to capture some really good conversations with some very noteworthy market experts. We'll look forward to getting those ready and sharing them with you in the coming weeks, coming months. Then on February 10th, we're going to be premiering our new show, Behind the Charts. It's really going to feature a lot of the interviews that we've been able to do with market experts, people like John Murphy, Martin Pring, others. We're really excited to bring their expertise to you, and we'll be doing that through our new weekly show called Behind the Charts. Also that week on Monday, February 10th, Grayson Rose, a fellow member of the management team, is going to be joining me to talk about some really cool new functionality related to fundamental and earnings data. On February 13th, we have the YouTube live Q&A, our first time going on YouTube live to answer your questions. So make sure you go to our YouTube page for Stock Charts, subscribe to our page, and hook up for notifications, and you'll know the moment we go live for Q&A there. So here's what has happened on the markets today, right? We've talked for this for a while, so none of this should be a huge surprise. And to be honest with you, I think that's one of the great benefits of technical analysis. For the last month, we've been talking about this 3210 level, which is the low from the end of December. We retested it a couple days later, beginning of January, and then we sort of took off from there. We kept talking about if and when we pull back, that 3210 level is pretty key. We then talked about the 50-day moving average, accelerating, kind of getting closer and closer, and those two things were going to be important. Well, don't look now. Today, they both came into play, right? We sort of hit an intraday low almost to the penny to those levels, and now the question is, where are we at, right? So I would say this. Number one, we've talked about a trend is a connection of highs and lows, peaks and valleys, right? The market never goes straight up, straight down. It's a pattern of peaks and valleys. That's what Charles Dow talked about when he came up with the idea of technical analysis, really pioneered Western technical analysis that most of us are familiar with. So an uptrend is a pattern of higher highs and higher lows, but that also means if we have lower lows and lower highs, we're in a downtrend. So what's happened now, I think, is on the daily chart, we have a low, we have a lower high that happened earlier this week, and now as of today's close, we have established a lower low. So in that short-term tactical time frame, couple days to a couple weeks, we're in a downtrend now. The larger question is, what does that mean for long-term investors, right? This is either a very buyable dip at which you want to accumulate on weakness, or it is an early chance to get out and take profits and protect yourself from further downside. I think next week is where we're able to answer that question a lot more completely. Right now we're at support, and so when we hit a support level, either this is the bounce that we see and we see accumulation, we see a higher high, we see a reversal of that pattern, or we continue to go down, we establish a lower low on this longer time frame, thinking about the longer sort of daily to weekly time frame. And so next week is really going to be crucial. Are we able to hold that 3210 level, or do we see further weakness? So that's what I would encourage you to be watching for going into next week. Here's what today's price action looked at on the short-term time frame. So you had the rally into the close yesterday that completely reversed. We had a ton of profit taking, a lot of more selling than buying through most of the session. It was essentially an unabated downtrend here during the trading day. The S&P down 1.8% almost. Mid caps down a little more, almost 2%, and then small caps down the most, 2.3%. So that's very much consistent with a corrective market, to be honest with you. On the sector side, the only one of the 11 S&P sectors up today was consumer discretionary, and it was just up a token amount. Utilities and then consumer staples were 2 and 3, followed by real estate. So besides consumer, which was probably driven mainly by Amazon with a pretty good earnings release and a nice jump in that chart, the rest of it sort of weaker, and so that's why it's more defensive than offensive. Energy continues to be at the bottom end of the list, followed in this case by technology, then industrials, materials, so sort of the late cyclical leadership selling off aggressively with technology down there as well. So the tech leadership story, the semiconductor leadership story has been very, very key, I think, to this extended bull market. That's been the thesis. Starting to feel like it may be unwinding here, and I think, again, going into next week, do we continue? Do we see a further downtrend with some of those names? I think that would be most telling. So today, as I mentioned, Amazon, the big winner, and even though sold off intraday, a big gap up to 2050, which is a beautiful new high for the chart, in a very much a position of strength. And I think that is certainly the outlier relative to others, although you do see other names that have improved pretty well. IBM's another one that gapped up very nicely today. On the downside, though, let's focus on what sort of led the way downwards. You have some biotech names. Biotech has been a group we've talked about historically, I think are kind of key to watch. That the healthcare charts had looked very, very good not too long ago. All of a sudden, they all feel like they've rotated lower. And now you have Amgen, which is a pretty major biotech name, a lot of market cap there rolling over. You also have things like Cardinal Health. There are a number of healthcare names that are on this list today, seeing the movements down here. In terms of what was up, so on a big down day, I always like to look at the other side of the coin, what worked. Broadline retailers, not surprised, sort of Amazon's group, personal products. And then you see some technology, computer services, also automobiles, fixed line telecom, that's sort of the old Ma Bell kind of things, AT&T, Verizon, and others. And then gold-related stocks, mining stocks were the only ones up. The rest were sort of down. And again, take a look at that when you have more time, maybe over the weekend or when you're able to focus on this. Really look at what sort of movements we've had. This was, by any measure, a pretty big digestion day, sort of taking care of things. Let's move on to Wrap the Week. And there are 3 things I like to do when we do a session called Wrap the Week, which is every Friday we do a Wrap the Week segment. This show is about connecting the short term to the long term. And I think once you lock in Friday's close, it's a perfect time to take a step back and look at the much longer term time frame. See how this week relates to the longer term. There are 3 things I like to do. I start with the Mindful Investor chart list. We'll then go to the RRG, looking at sector rotation. We'll finish with industry groups and how they fluctuated week close to week close. So from last Friday to this Friday, what sort of movements we've had. So starting with the Mindful Investor chart list, and again, if you're not familiar with this, if you go to my homepage, my articles page for the Mindful Investor, you'll see a link to this list. And when you bring up this chart list, you'll have a clicker right here to save it to your own chart list. You're welcome to subscribe to it that way. Copy these charts right into your own login and review them at your leisure. The first one is a very long-term view of the S&P 500, a 5-year weekly chart looking at the 21 and 34-week exponential moving averages. So this is a really long-term view. And a couple of just quick observations. Number one, even with the sell-off this week, the reason why we look at the long-term weekly chart is because on this time frame, the trend is still very much positive, right? It's still very much in place. Even with the pullback, it's still higher highs, higher lows. It's okay. So that's what I mentioned earlier. The pullback that we saw this week on that short-term tactical sort of time frame has turned negative. On the longer-term time frame, still positive. The next thing that would turn on this is what I'm looking here at the bottom. It's the weekly PPO. very similar to the weekly MACD if you've used that indicator. And if we would get a sell signal, sort of a sell signal from the weekly MACD indicator, it tells you that medium term, that intermediate term time frame is weaker rather than stronger. It's sort of switched from bullish to bearish. So going into next week, certainly possible that that could trigger, but it has not triggered yet. In terms of cap tiers, I usually change these colors over the weekend, so I've not touched them during the week, but I colored the small cap one amber earlier over last weekend because it was just testing support. I might actually switch this to red, showing more distribution than accumulation. Again, this is a total subjective Dave Keller visually looking at what breadth is doing. But I think it's worth noting that the broad large cap S&P breadth is still positive. Higher highs, higher lows, consistent uptrend. Mid caps has rolled over, sort of testing support. Small cap the weakest. That's consistent with what you see at market tops, but it does not necessarily mean that this is going to be a huge top. It's certainly following the pattern of previous tops, and I think that's why it's an important chart to watch. Do other breadth measures hold those support levels like the large mega cap ones have so far? Here we're looking at new highs and new lows. This has not updated yet for today, so I wouldn't be surprised if this increases dramatically after today's sell-off. So I'll have to sort of digest the closing values over a little bit of time here. So if you check it out later in the evening, tomorrow or Sunday, you'll see the latest view. But up until today, we've certainly seen an acceleration in new lows on the New York Stock Exchange, way more than we've had since last August, which was the last time we had a pretty decent sell-off. Before then, it was last May when we had a pretty decent sell-off. So that's why I'm saying we're sort of following that, bull market topping configuration. This is looking a lot more like the beginning of May, the end of July, and today's sort of following a consistent pattern there. We've looked at this before. This is the percent of stocks above their 50 and their 200-day moving averages. Just looking at the S&P 500 names, we're down to 75% of the S&P above their 200 days. So still 3 out of 4 above their 200-day moving average, which is great. If you look at the 50-day, though, it's back below 60%. So less than 6 in 10 are basically still above the 50-day. That means most of them, or a lot of them, have gone back below. It's 85% just a couple weeks ago. So that has rotated very heavily, with a lot of stocks breaking down through that 50-day moving average, which is right where the S&P is right now. That's why I think it's so important. Here we're looking at the ratio of consumer discretionary to consumer staples, and I'm going to go momentarily here onto the sector rotation, relative rotation graphs to look a little deeper at sector rotation. This is cap weighted at the top, so Amazon doing so well makes this ratio look a lot better than it would otherwise. At the bottom, we're looking at the equal weighted consumer discretionary versus consumer staples. These are the tickers over here. RCD and then RHS are two ETFs that track those equal weighted benchmarks. You can see this is actually broken down through support going through the end of the day today. So even with the strength in Amazon, sort of the average consumer discretionary is underperforming the average consumer staple stock, is how you would interpret that, certainly suggesting institutions are rotating more to defense from offense. I want to look now at semiconductors, and this relative performance of semiconductors has been a key chart that I followed for years because it's just a great bellwether for overall market stability. If this ratio is going higher, semiconductors are outperforming, tends to be a good market environment. When it's underperforming, that tends to coincide with when the market's not doing as well. We have now broken down through the 50-day moving average for the first time since last summer. We've broken to a new swing low for the first time since, I don't know when, back here maybe in August. So overall, certainly suggesting a more cautionary outlook for the near future. What I want to do now is look at the relative rotation graph. And again, if you're not familiar with this, Julius de Kempener does a really good job with his show, Sector Spotlight. So I'd encourage you to look at our YouTube channel, check out his work, because it gets into way more detail than we're able to do here. But I think it's just worth noting as I sort of rewind the last 6 to 8 weeks and fast forward, we've seen this rotation with a lot of things: healthcare, financials, industrials, materials, a lot of warning signs telling you that that offensive side of things has rotated weaker. The main outlier has been technology, which has remained in a position of strength. On the daily RRG, it looks a little different because we're going to look at the short-term, sell-offs. This week's action will take a little bit of time to reflect in here, which is why I like to look at it. It's more of a long-term view, but it's telling you that tech is really the only, strangely, the only real positive place to be on a relative basis, which makes sense. That's the chart that has looked sort of long and strong up and to the right. It's interesting to note utilities. Look at how much that has improved. And in general, when you own things that are going northeast and you underweight things that are going southwest, I've found in general you tend to be on the right side of the relative trends. And it's interesting to see how much utilities, probably the most improved award, would go to we go to utility. So if that continues to improve, I think that's a really important signal to look for. Finally, I like to finish off looking at the scooter reports. This is using our proprietary StockCharts technical rating. It's a percentile ranking system. We do it in a number of different groups. So we look at a large cap space, also a mid cap and a small cap universe. We look at ETFs and kind of mingle them all together. And then we've recently added industry groups. So we use the Dow industry groups. There are 60, 65 of them, if I remember right. And we rate them on a percentile ranking based on the relative technical attractiveness. So the higher the number, the stronger the uptrend. So I'm going to start just looking at what groups are the strongest over time. So right now, automobile is number one. That's Tesla, which I did a webcast last night for the TSAA, the San Francisco Technical Analysis Society, and I was asked about Tesla, which is near and dear to many hearts there in San Francisco in the Bay Area. So we talked about the chart of Tesla, and I mean, it's undeniably in an uptrend, and I think that's why the auto group looks so good. Followed by computer hardware, this would be Apple. Home construction, so home builders have actually been pretty compelling. And I also would note out that gold mining stocks are one of the top 10, which is kind of an interesting development. In terms of what moved up the most this week, we had a couple aerospace, mining within the materials sector, and then it's insurance, property and casualty insurance, insurance brokers. Nothing against insurance companies or gold miners, but when I see them in the top 5 list, I feel a little nervous about the overall market health, because that's not really the juice that you would expect in a raging bull market. In terms of the biggest underperformers this week on our ratings, we have healthcare providers, marine transportation, electronic equipment, fixed line telecom. So interesting, those stocks are actually up today, week over week. They've pulled back a little bit. It'll be interesting to see if those start to emerge into a position of strength. And boy, a number of healthcare groups on here which concern me: biotech, medical supplies, pharmaceuticals, and so on. We need to move on to a commercial break. We're going to be back answering your questions from the Final Bar Mailbag. So we'll see you in a minute. Hey everyone, welcome back to our show, The Final Bar. Please keep your questions and your feedback coming to us. The Final Bar at StockCharts.com is the best way to get a hold of us. The questions we're going to answer today all came from you in the last couple days, and again, we really appreciate you sending in your questions. Help us to make the show as relevant as possible for the questions you guys are trying to answer. So thanks so much for being interactive as much as possible. Let's get to the Final Bar Mailbag. So again, I promised Mrs. Keller I would limit the number of questions that I answer in this segment, because I tend to just go on a tear and try to answer way too many questions. So I've limited it to 3. I hope to stick to that, but no promises, honey. So question number 1, related to screening. We've actually had a lot of questions on relative screening on relative strength. And I have usually not consider that something we could do very well, and have not really talked about it. Had some really good discussions with Chip Anderson, who founded the firm, also Bill Shelby, who's one of our lead developers, and we actually reviewed one of the ways you can do that. I wanted to share it with all of you. So if you go into our scanning engine, and again, I don't have time to get into too many details, deep dive, but with Chip Anderson, Chip's done a great job of recording some of the ways you can use this. But what I'm going to do is start with the S&P 500 and say add. And then I'm going to say under technical indicators, percent relative. And our friend Bill has actually done a fantastic job adding the ability to screen on relative strength, which I find a lot of people actually are not familiar with, and that's why I wanted to share it with you. When you add this into your screens, it's a pretty simple just line right here. And again, if you add the scan component to the bottom, it's just a drop-down menu, very easy to do. This says the number of bars you're looking at, the benchmark you're going to use, and the percent comparison that you're trying to make. So what I'm saying here is I want stocks that are in the S&P 500 that have outperformed whatever I put here. So I'm going to put the SPY, and I'm going to say 20 days, and I'm going to say at least 5%. So these are stocks that have outperformed the S&P by at least 5% over the last trading month, for example, right? I can group this by sector or however want to do it. I'm going to put these in a new chart list, and I'm going very quickly, so apologies for that. But I just want to show you how you're able to start doing that. Now I'm looking for stocks that sort of fit this criteria, right? They've outperformed over the last 20 bars, which takes you back to the last week in December, essentially, 4 trading weeks, and we're up at least 5% on a relative basis. That actually works very well. I was testing it just actually over lunch with Chip just a little bit ago, talking about some ideas. We brought Bill over to talk about it. He actually reminded us, you cannot just do the S&P or some benchmark. You can actually do $ sector, $ industry, and it'll screen on stocks that have outperformed their sector by 5% over the last month. So the good news is you can do this. I challenge you to find cool ways to screen on relative strength. I think it's a really cool feature of our scanning engine that I was not as familiar with as I should have been. And I was talking to my producer, Gretchen. We'll have a segment in the coming weeks where we'll dig into this in a little more detail to share with you some of the ideas that you can use. But percent relative, it's under the technical indicator dropdown, and that is one of the ways that you can look for relative strength using the StockCharts scanning engine. Question number 2, the ADX line. Is a high ADX line good or bad? Really good question, and here's the way I would answer to it. If you're not familiar with ADX, and again, we have the whole chart school part of StockCharts.com is really well done and has an article on ADX and the DMI, the directional movement indicator, how they work and how they're calculated. So I'm going to gloss over some of the details here. Feel free to check that out in more detail if you want to learn about ADX and what it means. But here's essentially the way that I've thought about it. The DMI indicator, the Directional Movement Index, was designed by Wells Wilder in the 1970s. He's the same guy that invented RSI, which many of us, including myself, I use it all the time. So we had this really cool book, whose name completely escapes me, but New Technical Trading Systems or something like that. It's a really good book, and it's all handwritten calculations of all these ways to screen for strength and weakness. And he was really doing a lot of it on commodities, actually, at the time, finding ways to find trends in commodities. So what he did with DMI is you basically have a positive DI line, which is in green, and a negative DI line, which is in red. The green line, the positive DMI, is essentially saying, what are the highs doing over time, the high prices? The red DMI is calculated off of the lows. So how are the low prices doing? Are the highs getting higher? Are the lows getting lower? And it calculates that using some averages, and I've completely glossed over the math, but you get the idea. So the green's tracking essentially the highs, the red's essentially tracking the lows. And then a derivative of that is called the ADX, or the average directional movement. And so what this is telling you, this is a measure of strength. And I've stripped out that indicator and put it in this middle panel just on its own. So it's the 14-day ADX line. So the high or low ADX value does not mean anything for direction. That's what the green and the red lines are trying to tell you. If the green is above the red, it's an uptrend. The red is above the green, it's a downtrend. You can see how that lines up with the price. The ADX doesn't tell you direction of the price. It just tells you the strength of the trend. So the higher the ADX line, it means the stronger the trend. So what I've seen a lot of people do is stocks with an ADX above 20 or 25, depending on the volatility you're working with, that's a trending stock. So when the ADX is below 20, not trending. When the ADX goes above 20, it's in a trending environment. So if you screen for stocks with a high ADX and some other characteristics, maybe it's outperforming its industry, for example, you will find stocks that are in a consistent, strong uptrend according to this methodology. So the short answer is the level of the ADX means nothing for whether it's good or bad. It's just the relationship of the trend. How strong is the trend? The higher the ADX, the stronger the trend. So thanks for the question there. Third one, can you get earnings data on StockCharts? And this is a question that I've gotten so many times. I'm sick of saying we don't have it, and I'm so thrilled to answer as of today, we actually do have it. So we have a brand new feature we are just in the process of releasing. I got the green light. They promised me by 4 p.m. Eastern they would have this ready to go, and it seems like they were able to follow through just fine. We have a brand new page on StockCharts called the Symbol Summary page. If you don't see this, go to the Charts and Tools segment, scroll down, and you'll see a new section called Symbol Summary. You put in a ticker, and it'll look like this. We're going to have Grayson Rose on week after next. He's actually going to spend a lot more time on this, just talking about what it is, what it means. But what's really cool about this are a couple features I'll point out. Number one, this is sort of the homepage to start your analysis about a company. So this is Home Depot. It's a chart of Home Depot. It's a summary including when they report earnings next, dividend information, whether they have options, and all sorts of price-related data. We then get into a whole section called Fundamentals, where we're looking at valuation ratios, price to cash flow, their last earnings date, what percent of the stock is held by institutions, a lot of things that I think me and many other StockCharts users have been anxious for us to get, and I'm thrilled to tell you after a lot of work internally, we've been able to acquire the data, get it set up in a way that we're pretty happy with. We also have a whole section on technical data looking at things like the ADX line and where it is. We're getting into the scooter rankings. How has this performed relative to other stocks over time? And we're going to be adding more data related to earnings history and surprises, analyst ratings, all coming soon. We're sort of going to keep tweaking this product. But I did want to point out, up in the upper right, you can actually add the stock right to a chart list from here. You can also create a price alert. So if you want to be alerted when Home Depot does a certain thing, you can do it right from the symbol summary page. The last thing I will show you, just because the question was about earnings, if you bring it up on a stock which is right around its earnings report, a little banner will pop up on the top. So this tells you Amazon reported earnings yesterday. You can go down, see some further information about it. So Grayson Rose from the management team here will be here on February 10th. He's going to spend a little more time with this to make sure you're aware of it, but I did want to share with all of you. Great news. We do have earnings data, a lot more fundamental data on the system, much more to come. We're excited to share it with you in the coming weeks. Folks, we, however, need to wrap up the show with our 3 in 3. So at the end of every show, 3 charts in 3 minutes. If these charts are not on your radar up until this moment, I hope they are from here on out. Chart number 1 is the FXI. This is the China ETF. Obviously, this has been the story for the last couple weeks, and a lot of the global equity weakness that we've seen has really come from the news out of China, how they're dealing with all this, and really globally how we're dealing with the coronavirus outbreak. Again, not making any comment on the geopolitical or macroeconomic sort of things, but just on the charts, I have to point out the fact that the China ETF in the form of the FXI has this interesting symmetry, right? We had the sell-off from April down to August of last year. We then returned and got just above that previous high from April, sold off again. That's where we were right when we started to gap down a little bit. From there, we've gapped through a number of really important support levels like the 50-day and like the 200-day moving average. Just this week, we bounced off that 38.2% Fibonacci level, which was interesting because it lined up very well with the low from last month, from December. As of this week, we have now once again bounced off and gone further down, and unfortunately, this is what we call the dead cat bounce pattern, which is basically a big sell-off, a little jump before you continue. It's essentially a bearish pattern telling you it's just a relief rally before a further downside in the ETF or in the stock. So nearing the oversold range, it'll be very interesting to see over the weekend what sort of news we get, what this means for global markets opening on Monday. But overall, it's certainly, from a trend following perspective, certainly weaker rather than stronger. The relative strength definitely supports that. Moving quickly on through the other two, the Dow theory chart is my second one. We've talked about Dow theory over time as a traditional look at Dow Industrials versus Dow Transports. We had this confirmation of bullishness from November, the peaks for both of them, the peaks both of them earlier this month as they both confirmed new highs. That has started to come down a little bit, and I think what happens now with Dow theory is you have to key into these most recent levels. Dow theory was created based on closing prices, so that's how I like to look at it. And you want to make a new swing low. So for me, I'm looking at the low from earlier December on the Dow Industrials, the low from earlier December on the Dow Transports. As long as we remain above those, Dow theory says we're just fine. If we start to break below that, what transports certainly could do next week, that would certainly be a chink in the armor for overall equity strength. Finally, the biotech index, BTK, we talked about how this has rolled over. We saw Amgen on one of the weaker stocks list. I just wanted to point out it's certainly hit resistance from last year, has now sold off through the 50-day. We're nearing a pretty key support level around the 38.2% level, then the 200-day moving average just below. I'll be very interested to see if the biotech index is able to hold those lows or whether we get some further downside there. And ladies and gentlemen, that is our show for today and for the week on the Final Bar. Those questions we answered today came from you in the last couple days, so thank you so much for sending those in. Please keep them coming. There are no limit to the number of questions you can send in. The Final Bar at StockCharts.com is the way to do it, or just take a minute on the Q&A segment during the show and put a question in there. We'll make sure that we address it at some future point. Just a reminder, next week we're going to be on the road. So Monday we're going to feature a conversation we had recently with JC Peretz, which is a really cool window into his process into how he thinks about stocks and sector rotation, intermarket analysis. That's coming on Monday, and then we'll be recording a lot of great content from Atlanta and then from the Money Show in Orlando. So if you've not checked that out, go to moneyshow.com, check out the Orlando show. There might be some streaming options that you can take advantage of to watch some of the content coming from there. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Have a great week and a great weekend.